Did you know that a simple choice in how you structure your mortgage could mean the difference between owning one property or building a multi-million-dollar portfolio? In this video, I'm going to share a powerful strategy that many Australians overlook: interest only versus principal and interest loans, and why this choice can set you up for financial freedom, potentially with $1 million in property value, debt-free. It's Nick here from Handle Properties. I am an accountant turned financial planner turned buyer's agent. Today, I'm diving into something I wish more people understood from the start: interest only versus principal and interest loans. I'll break this down in the simplest way possible and show you why this approach can make such a huge difference. In my career, I've worked with clients who started with modest investment goals and others with millions to invest. One thing I've noticed is that financial success often comes down to knowing when and how to use the tools available to you. This video isn't financial advice. I'm just sharing my own insights, but I'm confident that you'll find value in thinking differently about mortgages and wealth building. When you buy a property, whether to live in or as an investment, one of the first big questions you will face is, do I go interest only or principal and interest? So what exactly is the difference? With an interest-only loan, you're paying just the cost of borrowing, the interest. Principal and interest, on the other hand, means you're chipping away at the debt every month, paying both the interest and a bit of the loan itself. Now, on paper, paying down the principal seems logical because you're actively reducing debt. But when it comes to property investment, cash flow is everything. The key to building wealth isn't just owning one debt-free property. It's about holding onto multiple assets that grow in value. To bring this to life, let's say you take out a $600,000 loan at an interest rate of 6.5%. With a principal and interest setup, your monthly repayments would be about $4,000 per month. By the end of 30 years, you'll have paid off the loan, but you'd have spent roughly $765,000 in interest alone. A lot of people see that interest figure and think, why would I want to pay the bank that much extra? They assume the best way to save is to pay down the debt fast. But here's where thinking long-term can change everything. If you go for an interest-only loan, your monthly repayments drop by around $800 a month. Think about what it could mean in the long run. With that extra cash flow, you may be able to afford an additional property sooner than you'd expect, doubling your potential gains over time. Secondly, cash flow is king. Let's say you buy a property in Sydney and it costs you $20,000 a year in negative cash flow. If you're earning $100,000 annually, that's quite a hit. Now let's say you wanted to buy a second property. You might have the borrowing capacity, but your cash flow is too tight. That's where interest only can be a game changer. By keeping your monthly repayments lower, you're freeing up cash flow, which means you're able to accumulate and hold multiple properties, allowing them to appreciate in value. Here's my rule. The goal is to hold as many assets as possible for as long as possible, because it's time in the market that builds wealth. Consider this. With two properties valued at $700,000 each and an average growth rate of 6% per year, in 30 years, each property could be worth around $4 million. That means your combined property portfolio could be valued at $8 million. Of course, you'll still have debt on these properties, but after 3 decades, you could sell one, use the proceeds to pay off the remaining debt on both, and end up with a debt-free asset worth millions. This strategy allows you to leverage the power of compound growth while maintaining the flexibility of interest-only payment. And let's look at the bigger picture. In 2024, the Australian residential property market hit an all-time high, valued at nearly $11 trillion, with the mean property price of $973,000. Property in Australia has grown consistently over the decades, with historical average annual returns of about 7 to 8% in many areas. The stats show that well-located property over time is a powerful wealth building tool. Now, a common concern I hear is, what happens when the interest-only period ends? Typically, the interest-only period lasts 1 to 5 years, after which you'd either switch to principal and interest or refinance. The good news is, if your strategy is to grow your portfolio, you can refinance and potentially get another interest-only period. Here's a real-life example. Let's say you go interest-only on 2 properties worth $700,000 each, with a 6% growth rate. In 30 years, your portfolio could be worth $8 million. Assuming you originally borrowed $1.2 million, selling one property for $4 million could cover the debt on both properties. After costs, you'd still be left with a debt-free property valued at millions. The beauty of this approach is in its simplicity. By opting for interest only, you're focusing on cash flow and growth rather than rushing to be debt-free. This strategy isn't about reckless borrowing. It's about understanding the leverage that debt provides and using it strategically to build wealth over time. At Handle Properties, our goal is to help everyday Australians understand and leverage the power of property investment. The reality is, very few financial planners talk about this because property advice isn't usually part of their product mix. But for middle-income Australians wanting to get ahead, property is a solid, accessible asset class that, when structured correctly, can help build substantial wealth over time. If this video has made you reconsider the possibilities, hit that like button, subscribe for more, and if you're ready to explore how this strategy can work for you, book a free call with us through the link in the description. Thanks for watching, and I'll catch you in the next one.